Hey, good morning, everybody, and welcome to the Ankerstar Wealth Morning Show early edition. And we only really do this for one reason, and that's when we think there's some words that we need to get out kind of before the market opens, because obviously we're having a significant event from this weekend. So a little different structure. First of all, I'm casting from my truck. I'm not at home today. We dropped Allison off this weekend in Alabama, and Irene's still sleeping. So there's all of the stuff we have going from our college visit, but everybody else is in the home office today. So if you do have questions on days like today, it's a good time to reach out to your advisor, especially if you're really getting kind of freaked out by what you see. But the format of the show today is going to be, I'm going to talk a little bit about why I think this is happening. Remember, it could be 1,000 different things, so I'm not necessarily correct, but I'll talk about some indicators on why I think the sell-off is kind of particularly nasty this morning. I'll talk about if we have a recession a little bit, what I kind of think, how it'll all play out. That's all just kind of some theory. Then Mike's going to roll in with some charts to kind of show you exactly where we are this year and some recession stuff. So more of the factual stuff after I go in and pontificate as why I think this is happening. But I wanted to get this out early so you at least know what's going on in our minds out there managing your money. Before we get started, this is a financial education presentation. You have to do your own due diligence to act upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com, and the opinions expressed are mine and Mike alone. Let's go to the window where I will show you how ugly this is. Okay, you should be seeing the CNBC main page here. Pretty ugly. So NASDAQ's down 6%. To kind of recap where we were last week, remember 2 ugly down days. Monday and Tuesday were down, and then Chairman Powell and the team from the Fed reassured us. On Wednesday, we had that huge Wednesday up day, and then some earnings misses and some other thoughts kind of out there. The market pretty well rolled over on Thursday and Friday. So part of it is just that's a continuation of what's going on here, with Fed interest rates and the possibility for a recession. So that's kind of one reason. But this is worse than I had expected. I expect the market to kind of continue down a little bit while that conversation is working itself out. But obviously, this is pretty dramatic, and it's accelerating going into the open. So there's that piece of it is the Fed piece. Now, also, you have one of the most respected names in investing. Warren Buffett is selling shares hand over fist of 2 of his favorite stocks, Bank of America, and he sold half of his Apple stake. Yeah, the timing of that's not good, Warren. Can you hold off for just a second? I think you're freaking everybody out. Maybe nobody's paying attention, but it was, at least it's a conversation we're having in the office Friday of, hey, Uncle Warren, what do you know? Share with us. Don't just sell the shares. So, what are you thinking? So anyhow, so he's selling a lot of shares of some big names. In a way, he has enough to where he actually does move the market a little bit legally, of course. But I think it just added to some of the selling you saw coming on from the big earnings we had last week. And then lastly, this morning, what really freaked everybody out is, I don't pay a whole lot of attention to the foreign markets. Usually the foreign markets are the tail and we're the dog, right? So it's kind of the U.S. market kind of drives the international scene. So if we have a big down day, then the next market open for around the world is generally down, and vice versa if we have a big up day. But the Japan stock market had their worst drop, 12 plus %. I mean, just it's like a Black Monday type event, like one of their worst in history, if not the worst. So I think we now have a hangover of the massive selling that went on before the market opened. So that's another thing. And then lastly, there was a sell-off in crypto. Don't know if that's related or not, but certainly when you're looking at 15+% in Bitcoin, worse in Ether. So those things can shake the markets pretty good. And then lastly, when you have a weekend, you have 2 days where people are kind of convincing themselves of the best or the worst. And then that's why it kind of plays out on Monday morning. You tend to see more of those big moves on Monday, and really it's like 3-day weekends are really even worse after that. So that's why I think it's happening. So as far as my Fed rate cut prediction, we started the year, we were right. There weren't going to be any rate cuts this year. We switched when we saw evidence to otherwise, saying there will be 2 rate cuts. I said after election. I'm changing that now. It'll be before the election. It'll be the next next meeting at the end of September. And then I think there will be 3 rate cuts now. Our investment advisory board, we had a working meeting the other day and started. Mike, of course, gets paid to bring out charts and evidence. So it's not just what Steve thinks, right? It's the facts behind all of it. And we started looking some pretty ugly stuff, which you've heard him talk about before, about a lot of, credit card debt and delinquencies and some stuff that's kind of not good for the overall economy. So that's what I think for rate cuts. And then recession, I do think that we are going to have a recession now. And, even though it's like, are you sure you just aren't caught up in a few down days in the market? No, there's enough evidence out there. And so remember, to have a recession, it has to be declared officially by the Office of Economic something or other. But what all of us use is back-to-back GDP, negative GDP quarters. Well, that means that 6 months into a recession, you've just called it a recession. So we could be in one now to some extent. I'm not saying like we're in the mother of all recessions, or it's going to be that way, but we could be in it now already, but we aren't even going to call it that until January. Isn't that crazy how that works? But it is what it is. I think we do have a recession. I don't think it's going to be that bad. I think that, it's going to be something we can handle. Sure, unemployment may continue to go up a little bit. Stocks can get hit a little bit, but I don't think it's going to be anything that we look back in history of anything more than just a blip. So anyhow, that's my opinion. Obviously, we're collecting data every day, and those are all thought pieces. But I will stop sharing my screen so we can get rid of this red, and then look to see what Mike has prepared for us with his thoughts.
Yes, I'll start off with saying, when I woke up to see this article from Reuters, at 4 a.m. this morning, Nikkei down 13%. I wanted to go back to sleep, but I've been up ever since. So,
Yeah.
And obviously that's a huge number, 13%. What I also want to say is there's also some geopolitical events over the weekend also impacting it. You also have, election uncertainty, impacting all this. All these 3 things kind of hitting at the same time. So let's take a quick look at some numbers. So I was getting emails. Thank you for someone that emailed me at 1 a.m. And I replied at 5. And I said, when these days happen, I like to take a step back and just see where we're at. It makes me feel at least a little better. If I just looked at the last 2 weeks, I'd be like, oh my goodness, but let's just take a step back. So this is the S&P 500 since the beginning of the year. Right now we are, it says according to this, up 5.59%. Obviously, you see the big drop in this month in July, or last month started July. We're back to just a little bit higher than we were in January, February. So, that's one thing. And let me look at the NASDAQ, which is a little uglier. At this point, it says we're up 1.29%. And you can see, once again, went up really nice up through June. July 10th, I think, was the day. It was like we're at all-time highs. When I did the weekend report, it was like, 5 weeks in a row. It was like new highs, new highs, new highs. Now it gets exciting. So volatility is here. We've been preparing for it. We had de-risked the portfolios, certainly somewhat. I mean, it's not like we went to cash or shorted stocks, but we had de-risked somewhat, which was a good choice. So let me show some other things that give me confidence of the future. So this is a graph of the S&P 500 for the last 54 years. And it has and this comes from First Trust, so thank you, First Trust, for giving this to us. But it shows all kinds of events from 9/11 to the great financial crisis. But you can see the overall chart. It's up and to the right. Yes, there's blips, there's downturns. This at some point will be a blip. It will be a slight downturn. 10 years from now, we'll look back and it won't look like this. I mean, or it'll just continue up. Here's another one. This one goes out back to 1942. But what I like about this is it does show the recessions in there. So those light gray lines are recessions, and you can see the market drops. 2008 being the biggest one recently. I mean, not counting 2020, but you could see that drop and then the recovery. And then let me show you one more. And I like this. You know, if you're a data person and you're like, well, what does this all mean? Okay, those orange numbers at the bottom are when it dropped in the recession drawdown. So you can look at 2020 or 2007 through 2009 and that great financial. You know, those are some ugly numbers, down 34%. We are not down 34%, thank goodness, but you know, we're down definitely 10 to 15% off the highs. So it feels rough. But what I like are the bars to the up and to the right, which are the light blue, medium blue, and dark blue. And that is the 1 year, 3 year, and 5 year return after that recession drawdown. And you can see that, and even all the far right, you can see the average. So yes, the drawdowns are painful, down 30.6% on average. But then you can see 1 year later up 43%, which is almost break even, maybe not quite, but 3 years later up 65%, and 5 years later up an average of 101%, which is basically doubling. These are the data that give me some confidence. And let me show you one more chart that I really like. And this one comes from JP Morgan Chase, so thank you to them. But this shows the max drawdown in a year. So generally, those gray bars are up. There's some years that they're down, but that red number is what it drew down this year or in that current year. Obviously, this one's not up to date. It's a few days out of date, but the market is, 5-6% up for the S&P, and this drawdown is approximately 10% so far. Now it can continue down further, and you can see many years it has. And the best year to really look at an example of this is, let's take a look at that COVID year. The COVID year, at one point, it was down 34%. But by the end of the year, it was up 16. And I know I watched Steve's presentations during that, and his leadership guiding us through that time. It's scary in the moment, but that's why we're here. You can give any of us a call. Be glad to discuss this. But I do want to close on a positive note before I turn it back to Steve. Positive note: when this kind of thing happens, the 10-year bond rate goes down in yield. And what that means, and generally the 30-year mortgage is kind of calculated very correlated to the 10-year bond rate. So if you're on the verge of buying a house right now, you might want to call your bank today. The interest rates have probably dropped. So I'm not saying to rush out and buy houses. I'm not quite that confident. But I'm saying if you are on the verge and you're just like thinking about it, you might get a pleasant surprise that your interest rate is down a little bit. So with that, I'll turn you back over to you, Steve.
All right. Appreciate that, Mike, for adding some factual stuff there. I'm going to share my screen out yet one more time because I do something that Mike said, pointed out is a good thing. We have been, de-risking the portfolio. That doesn't mean your portfolio is not down today. It assuredly is, except for just a few that are all bonds are likely going to be up today. But here's a real-time look at the top 10 holdings before the market opens. These numbers will be smaller here in 44 minutes, also assuredly. But, we have Apple, Amazon, Google, and Bitcoin kind of as our long plays. And then our protection plays are the treasuries. We have bonds. Then we have some other names that you may not even understand what they are, but they're all portfolio protection. So we have that in place. So, if the market's getting hit 5% today, then we're trying to, we consider it a success if you're only down like 2.5%, 3%. Obviously, you still see numbers getting smaller, but it's our job to mitigate that backside or the downside, excuse me. And if you've had a client meeting with me, I always show the 1 year chart, and you can kind of see our portfolios, they track down approximate with the market, saving a little bit, but it's that snapback whenever this, the snapback happens, then that's when you see that outperformance to the upside because of the big tech names that tend to outperform. No crystal ball, can't guarantee, but they have in the past, and that's how I expect it here soon too. Also, when you see massive selling like this today, it is often followed by a big green day because money is like water. It has to go somewhere. So money doesn't just sit in cash. It's going to come flowing back in at some point in time. So anyhow, that's just something to think about. And then lastly, Mike talked about going to cash. I'll stop sharing here for the last part of this. When you have slow sell-offs and you get to that, point of, okay, things are predictable and not quite crazy, like COVID was obviously crazy, it was all over the place. When you do have kind of those slow sell-offs, there is a time there where if you're going to go, to cash, I call that the getting off the coaster. If you're going to get off the coaster, you want to get off at that, 5 to 8% down when things look ugly, right? Well, since we're tech heavy, a lot of times the bigger names are already like 15% down. So we're kind of past that point of getting off. So some folks are like, well, do I want to sell today? And it's like, I would say no. I mean, it's up to you. It's your money. Call your advisor. We'll talk it out. But ultimately, if you're like, nope, we got to start selling some stuff, we will honor that. It's your money and we are the advisor. But really, once you kind of get to that 15%, you're better off traditionally on just kind of holding it. Again, we have protection in place so the dip won't be as bad, but kind of holding on to those stocks and waiting for that snapback, whether it's in a week or whether it's post-election or whether it's in 2025. You tend to be better off if you're just holding through with the big names out there, the Apple, Amazon, Google, Microsoft, ServiceNow, NVIDIA. I mean, those names are nothing has changed over the weekend with those. So it's just that, the markets are kind of spooked right now. So, all right, that's enough of a philosophy from us. I will say this, that if we start having moves like this down and up, we'll do our show. We do it almost every day anyway, but we'll do it before the market open each day to get this information out into your hands. With that, thanks, Mike, for all the stuff you added there, and we will talk to you guys tomorrow. Have a good one.